Investors, something just happened this summer a few weeks ago that caught my attention. For more than 15 months, our team here at Oak Harvest has been asking one big question. Is today's AI boom starting to look a lot like the dot-com boom? I want to be clear, we haven't used the comparison as a reason to panic. In fact, our view has been that if a market is still early enough in a speculative cycle, high valuations alone don't necessarily mean the rally has to end. And now the comparison's getting even more interesting. Earnings are very strong, AI spending is booming, semiconductor spending is rising, the stock market's hitting new all-time highs. More stocks are joining the rally. And now something new has happened that we haven't seen in decades. The United States and Japan stepped in together to support the Japanese yen. The last time we saw something similar was June 17th, 1998. That was during the Asian financial crisis, right in the middle of the dot-com boom. So here's the question that hit me this weekend. Did Kevin Warsh and the global policymakers just create a new version of the late 1999 Y2K liquidity window? Because that period of added liquidity happened right before the final huge run in technology stocks that ended with the NASDAQ peaking in March of 2000. I'm not saying that has to happen again, and this historical comparison isn't a forecast, but that setup important enough that investors should understand both the similarities and very important differences. Everyone, this isn't a story about just AI. It's about earnings, interest rates, liquidity, the dollar, and how those forces may affect the markets from here. The framework we've been using has helped us focus on the things that we believe matter most. That doesn't mean every future view will be right. Markets can change quickly. No framework can predict every turn. The goal isn't prediction, it's process. Instead of reacting to fear, headlines, or whatever financial TV is yelling about today, we want to keep watching the real drivers underneath the markets. Before we move on to the topic, I want to ask you for one quick favor. Most of the people who watch our videos aren't actually subscribed yet to the channel. So if you've been finding these market updates helpful, please take a second and hit the subscribe button. It helps YouTube know what you want to see more of, if you want to see more of this content, and it really helps us grow the channel so we can keep bringing you these updates. All right, let's get back to the subject matter. Back in 2025, our work kept coming back to three big things. First, earnings. Second, interest rates, including real rates and inflation expectations. And third, the US dollar. Our published outlook remained constructive on the bull market while also recognizing risks from tariffs, war, inflation, and changing financial conditions. Then our outlook for the first half of 2026, we described a market that could have a rougher ride with the possible weakness early in the year, followed by stronger conditions in the summer. We also said that the dot-com investment cycle was worth watching as a historical comparison. Before the sell-off late in the first quarter, we described the AA market as being in the seventh inning stretch. Not necessarily early, not necessarily finished, more like a market taking a breath after a strong run. Then in June, our second half outlook discussed the possibility of a stronger third quarter, followed by a more difficult fourth quarter. So far, we've seen a strong summer rally. On August 7th, the S&P 500 closed at 77.57, while the NASDAQ also posted a strong week. But I want to stress something here. The historical outlook lining up with part of what later happened doesn't mean the next outlook will be right. We're showing you the process, not claiming the ability to predict markets in the future. And that process says watch earnings first, then interest rates, then liquidity, then the dollar, then energy. That's much more useful than following the mood day to day. And this brings us to what I believe is the most important part of this story. Earnings, because earnings are still an engine. FactSet August 7th report showed very strong results. With 88% of the S&P 500 companies reporting, 86% had beaten earning estimates, and 76% had beaten revenue estimates. Second quarter earnings growth was about 50.5% from 1 year earlier. At the end of June, analysts had expected only 23.1% growth. Now there's a catch here. Alphabet and Amazon had large one-time investment-related gains. Those gains increased the overall earnings number. However, if we remove those two companies, the S&P 500 earnings growth drops from about 50.5% to 32%. That's a big difference, but 32% would still represent very, very strong earnings growth. Revenue growth was around 15%. That's the strongest growth since 2021. And it's not just one quarter. FactSet currently expects earnings growth of about 27.5% in the third quarter and about 25.2% in the fourth quarter, or for a total 2026 calendar year growth rate of about 30%. And then next year in 2027, earnings growth of around 13.5%. Those are estimates, of course. They can change sometimes very quickly. Current bottoms-up estimate, the S&P 500, put that number at around $359 for this year and $405 for 2027. Okay, everyone, so stocks aren't cheap. The S&P 500 trades near around 20 times expected earnings. That's somewhat above the 10-year average of around 19 times, but valuation by itself has historically been a very poor short-term market timing tool. And here's one important difference worth watching compared to the late 1990s. For 6 straight quarters, the market's PE ratio has declined while earnings have risen. In other words, earnings have been doing most of the work here. Here's another way to look at it. Using the old market rule of thumb of 10-year Treasury yield, which is near around 4.65%, divided 1 by that, gives you a PE of around 21.5 times. Multiply that by the expected 2026 earnings of roughly $359, and you get an S&P 500 value near 77.22. As of this recording last Friday, the index closed at 77.57. That doesn't mean 77.22 is the correct value of the market. This simply is an illustration of how interest rates and earnings can interact in valuations. Markets can trade far above or below simple valuation models for long periods of time. For retirees, that distinction matters. A high valuation combined with falling earnings can create serious risk. But a high valuation combined with rapidly growing earnings can behave very differently. Neither situation removes the risk of market losses. So let's move on to AI. The dot-com boom required a huge physical build-out. It needed fiber. It needed routers, servers, switches, and computer chips. It also needs huge physical build-out. It needs GPUs, memories, advanced chip packaging, networking equipment, optical links, power systems, cooling, and enormous amounts of electricity for data centers. FactSet's numbers show how important this build-out has become. Technology revenue grew at about 35.9% in the second quarter. Semiconductor and semiconductor equipment revenue grew about 77%. Semiconductor earnings grew about 135%. And if you remove semiconductors from the technology sector, tech earnings growth drops from about 70% to roughly 34%. That's why we describe semiconductors as the toll road underneath AI. AI needs compute, and compute needs chips. But this is also where one of the biggest risks is growing. AI spending has exploded. Large technology companies are spending enormous sums of money on data centers and equipment. So I think the question is changing. The old question was, is AI real? There's a growing evidence that AI demand is real. The more important investment question is now, how much money will companies eventually earn on the next dollar they spend building AI infrastructure? Microsoft, Amazon, and Google have recently provided some encouraging signs, but investors still need to watch the return on that spending carefully. Demand for computing power is also growing as AI agents create more searches, more tasks, and more machine-to-machine activity. Cloudflare recently discussed the rapid growth of AI-related traffic on its networks. And there's another important difference from the dot-com era. Many of today's largest AI beneficiaries were already producing substantial revenues, profits, and cash flow. At the same time, OpenAI and Anthropic remain private, which means some of the AI-related speculation remains outside the public stock market. So yes, parts of the cycle could become too speculative. Yes, there are similarities to the late 1990s, but this isn't an exact copy of 1999. Everyone, this is where the story gets even more interesting, because strong earnings and strong AI spending are only one side of the market. The other side is liquidity, and the events surrounding the yen may have changed that part of the story. Here's why. The dot-com bubble didn't end right after the financial stress of 1998. After the Asian financial crisis and long-term capital management collapse, financial conditions changed and policymakers changed. That's when 1999 happened. The Fed was raising interest rates, but officials were also worried about Y2K. Banks and businesses feared computer problems could disrupt their financial system when the calendar changed to year 2000. Most people find that hilarious nowadays, but it was a real concern back then. So back then, the Federal Reserve created special liquidity tools designed to reduce that funding risk. One important facility opened on October 1st, 1999 and lasted till April 2000. That program didn't create the dot-com boom by itself. That's important to remember. There were many forces pushing technology stocks higher. but the additional liquidity helped reduce one major financial system concern at the time when investors were already willing to take more risk. From October 22, 1999 through the NASDAQ peak, March 10, 2000, the NASDAQ rose sharply. Again, that historical return isn't being shown to suggest today's market will do the same thing. It's being shown because the timing of liquidity changes can matter. So let's fast forward to 2026. I'm 60 now, not in my late 20s. The United States and Japan just stepped in to support the yen after significant weakness in the currency, with the New York Fed carrying out transactions on behalf of the US Treasury. That's unusual, but we need to be very careful with the comparison. This wasn't a new Federal Reserve quantitative easing program. It wasn't the same thing as the Y2K liquidity facility, and it doesn't mean broad monetary easing has begun. But here's the question worth watching. Could actions designed to reduce stress in the global currency markets also affect financial conditions and global liquidity? It's very possible. And if policymakers take additional steps, financial conditions could change again. That is the more bullish side of the analogy. But there's a very different side investors can't ignore. Today's inflation and interest rate environment isn't the same as late 1999. The 10-year Treasury yield ended August 7th around 4.64%. And markets continue to debate the future path of Federal Reserve policy. Remember how we think about the 10-year Treasury yield. It's basically made up of two important pieces: real interest rates and inflation expectations. If inflation expectations rise, higher discount rates can put pressure on stock valuations. If real rates rise because financial conditions tighten, that can also put pressure on valuations. For growth companies whose biggest profits may be years into the future, higher rates can matter even more. And if both real rates and inflation expectations rise together, that could create much more tougher environment for growth stocks. So here's the real question. It isn't, did the Federal Reserve turn on the money printer? That's not what happened. The better question is this: did policymakers reduce one source of global financial stress at the same time earnings and AI spending are accelerating? If they did, could easier financial conditions help extend the current market cycle? Possibly, but it's only one possible outcome. History shows that some late-stage bull markets can become faster, more emotional, and more speculative before they eventually end. History also shows that markets don't follow a script. That's what makes the 1999 comparison useful. Not because 2026 has to end the same way. It doesn't. Comparison is useful because it gives us a framework for understanding what might happen when strong technology investment, rising earnings, investor excitement, and changing liquidity all come together. At the same time, today's market appears stronger in some very important ways than much of the technology market was near the dot-com peak. Many of today's AI leaders have real earnings, real margins, real revenue, and real cash flow. But strong businesses can still become expensive investments. The key distinction: so the story isn't, this is 1999 all over again. The story is, we may be entering a part of the cycle that shares some features with late 1999, while the businesses underneath today's market are very different. That's a difference maker. And I think we should give investors both confidence and caution. Confidence because the earnings story remains strong. The AI build-out is still happening. The semiconductor cycle remains important, and the market has continued to show strength. But caution because strong markets don't eliminate risk. Valuation matters, interest rate matters, liquidity matters, and investor behavior matters. Late cycle markets can sometimes feel their best when investors are becoming less careful. That doesn't mean investors should automatically run away from stocks. And it doesn't mean investors should automatically buy more. It means investment decisions stay tied to your financial plan, your time horizon, your need for income, and the amount of risk you can eventually afford to take. For retirees and people close to retirement, that matters even more. You don't want one exciting market story to replace your investment discipline. AI may change the world, and some AI-related investments can still be overpriced. Both things can be true at the same time. So here are the 4 things I'd keep watching. First, earnings. Earnings remain an important support underneath this market, but estimates can change, so we'll keep watching whether those expectations continue to rise or begin to weaken. Second, the AI spending cycle. The build-out continues, but the next question is return on investment. How much profit will companies ultimately generate from all this spending? Third, interest rates. If real rates and inflation expectations rise together, that could create increasing pressure on growth stock valuations. And fourth and finally, liquidity. If the yen intervention turns out to be part of a wider change in global financial conditions, then the late 1999 comparison may become more interesting. But if real rates, oil, and the dollar rise together, that would be a warning sign that financial conditions are becoming more difficult. For retirees and near retirees, I think discipline is straightforward. Stay focused on earnings, respect valuation, watch the cost of money, watch liquidity, and make investment decisions based on your own financial plan rather than one market forecast or one exciting technology. Because a great technology doesn't automatically make something a low-risk investment. History doesn't repeat exactly, but sometimes it gives us a rhyme worth paying attention to. And right now, that rhyme's getting louder. And if you're retired or getting close to retirement and you'd like a second opinion on your investment or retirement plan, give Oak Harvest Financial Group a call. We offer a free consultation where you can learn more about your goals, your income needs, and the risks you're concerned about, and help you understand whether there may be ways to improve your plan. There's no obligation. Just give us a call or visit the link below to schedule your free consultation. We'd be happy to talk to you.